Did you know the mortgage defaults in Australia just dropped for the first time in 2 years, even with interest rates still sky high? It sounds crazy, right? I mean, if you look back, we had 2 years of aggressive rate hikes. There was inflationary pressures, and don't forget the cost of living nightmares. And yet somehow more borrowers are staying afloat. But here's the twist. It's not because people are suddenly earning more, it's because the smart ones are playing the game differently. And if you're not already investing like they are, you are falling behind. So today, guys, we're diving into why defaults are falling but first home buyers are still stressed. Then we'll look at how offset accounts just hit a record $300 billion. And next on the agenda, why interest-only loans are misunderstood and who's actually used them smartly. And finally, what it all means for you if you're planning to invest in property right now in 2025. So let's get into it. Firstly, let's look at mortgage defaults just dropped for the first time in 2 years. Here's what it means to you. Yep, guys, for the first time since late 2022, mortgage defaults, loans overdue by 90 days plus, actually dropped slightly. The non-performing loan rate dropped from 1.06% to 1.05%. Now, I know what you're thinking, that's a tiny drop Q, but it's the first reversal in a long time a while. Let me put this into perspective for you guys. Before the rate hike started in March 2022, default rates were at 0.78%. By late 2024, they hit 1.06%. And right now, we're seeing the first sign of pressure easing. But here's the kicker, guys. It's not happening evenly across the board. What do I mean by that? I'm talking about first home buyers and owner-occupiers. You guys out there, you guys are still copying it the worst. Because in the default rate data, the majority of the defaults are first home buyers and owner-occupiers, not investors. Now, this brings us to our next point. Let's talk about offset accounts. Did you know that Aussies have parked over $300 billion in them? I'm telling you right now, guys, offset accounts are the saving day. In December 2024 quarter alone, Australians stacked up another $12.9 billion in their offset accounts, bringing the total to a record-breaking $300.7 billion. That's now 11.4% of all mortgage credit, the highest since APRA started tracking this in 2019. Now let's break it down, guys. Since March 2022, when the RBA started raising rates, offset balances surged by $72.6 billion. That's a 32% increase in under 2 years. But here's what most people miss. This isn't just about shaving interest rates. It's actually a defensive move. With rates shifting above 6% back then, borrowers are using offset accounts to slash interest rates without paying the principal down. But you might be wondering, why use an offset account? Why pay interest only? Why Q? Because, guys, this gives them more flexibility, more liquidity, and more control, especially if you're an investor. So right now, if you're not using an offset account effectively, you're probably handing thousands of dollars straight to the bank. And right now, this is where we look at while offset accounts are helping some buyers stay afloat, not everyone is navigating the storm equally. Did you know the data shows owner-occupiers are struggling way more than investors? And here's where it gets juicy. Borrower type percentage 90 plus days in arrears right now, those people are owner-occupiers. Owner-occupiers are sitting at 1.11%, which means 1.11% of owner-occupiers are in arrears default overdue for more than 90 days. And you might be thinking, what about investors? Well, investors are sitting at 0.84%. Now, the above data is for people who are paying principal and interest repayments. The next data I'm going to be telling you right now is investors that are paying interest only. They're sitting at 0.43%, which means 0.43% of the entire population that are investors are in arrears default. So as you can see, guys, I don't know whether it's obvious, owner-occupiers at 1.11% default versus investors at 0.43% of that population in default. And if you're still scratching your head thinking, well, what does that even mean? Well, the translation is, guys, first home buyers and owner-occupiers are under the most mortgage stress. They're the ones drowning in repayments right now because unlike investors, they don't have the same tools. For example, no rental income, no tax deductions, and no exit strategy. For investors, they can always sell off that property. But for owner-occupiers, they can't, which means for seasoned investors, we're currently chilling. And if you're still scratching your head wondering why, how that doesn't make sense, Q, let me tell you why. The reason they're chilling right now, the reason investors are chilling right now is because they understand leverage. It's because they follow this channel. They hit the subscribe button, they hit the like button, they hit the bell notification for more videos like this because they're learning, because knowledge is power. I want you guys to notice, when you understand leverage, buffers, and cash flow. And most importantly, when investors learn that they're not using emotions to invest, and when you're not emotionally tied to your properties, you start thinking like a businessman or businesswoman. So if you're a first-time buyer trying to play the games without a strategy, I'm telling you right now, you're entering a gunfight with a butter knife. So right now, let's talk about the tool that separates amateurs from the pros. We're talking about interest-only loans. And mind you guys, this is not financial advice. This is just my general opinion. Let me first premise, interest-only loans aren't very popular. And you know what, guys? That's a good thing for smart investors. According to APRA data, interest-only loans are still very rare. They've only crept up by 0.01% in the last quarter in terms of usage. Currently, they're sitting at 10.9% of all loans out in Australia at the moment. And compare that to 2019 when 23% of loans were interest-only. Now, here's the real secret that I want you to reel in to listen to. If you're paying principal and interest on your investment property right now, not financial advice, but you're doing it wrong. You're actually reducing the principal too quickly. And I know what you're thinking. It sounds responsible, but actually it's killing your ability to maximize negative gearing. And you know what's worse? You're locking up cash in an asset you should be leveraging. I'm telling you right now, the smart investors, the ones that I work with, they're using interest-only loans strategically. And when I say strategically, not all their property portfolio is interest-only. Some of it is principal interest, even investment properties, but a majority is interest only. And the reason I say strategically, because sometimes in the property portfolio, we want to maximize certain properties with lower repayments, more reserves, and more control for future lending. Now, mind you guys, I'm not telling you to take shortcuts. What I'm trying to tell you is to play the long game. Now, right now, we'll move on to what it means for you and why my investor clients are winning right now. So let's bring it all together. 1, borrowers are now playing defense. A lot of smart investor clients that I'm working with right now, they're not going YOLO on their lifestyle at the moment. They're building buffers and they're stacking offset cash. And let me repeat that to you. Stacking cash in the offset account. That's a smart move. And number 2, defaults are flatlining, but still cracks are forming. I mean, like I showed you just then in terms of short-term arrears, they ticked up slightly from 0.58% to 0.59%, which means the pressure is still lurking. As you can see, rates are still high. Yes, they're coming down a little bit, but still compared to the COVID days, they are still kind of high. And I'm telling you right now, some borrowers might buckle, especially if their income is dropped. For example, their partner has taken maternity leave. Number 3, investors are holding strong. My clients, they're thriving at the moment because they're not emotional buyers. They're strategic buyers. They use interest-only loans, buffers, and smart structures. They're not buying dream houses. They're buying assets that pay them to hold on. Now, next, this is my final thoughts. Just because defaults are falling, it doesn't mean we're out of the storm right now. But the numbers are clear, guys. People who are prepared, buffered, and thinking long-term are the ones staying afloat. If you're still paying principal on your investment loan, thinking to yourself, it's a responsible thing to do, right? That's what my parents say. Well, think again, guys. You're actually giving up cash flow, losing tax benefits, and slowing your ability to grow. And right now, if you're a first-time buyer, thinking the game is stacked against you, well, you're kind of right. It is, unless you learn the rules. So what I'm trying to tell you in this video is be the one who understands the game, not the one who defaults trying to play blind. So yeah, guys, if you want to stop guessing and start building a smart property portfolio, if you want, I have a 15-minute strategy call and a 60-minute deep dive strategy call. Just choose one in my bio link below or find the link somewhere over here. Let's keep building smart together. And if you've watched thus far and you like this video, smash the like button, hit the subscribe button, and hit the bell notification for future videos like this. And until next time, I'll see you in the next Property Roast.